bottom line is that it's absolutely happening. Commodity markets are being de-dollarized. Global central banks are no longer sterilizing U.S. deficits and haven't been for nearly a decade. They're buying gold instead of treasuries. And I think the world's going to keep moving in that direction. And it's a little bit of a spur and break of like, okay, this process is happening very steadily, maybe even accelerating. But as it does, once the dollar gets high enough that it creates a problem, then the Fed and other authorities have to step in and inject dollar liquidity, get it back down.
Welcome to the Jay Martin Show. If you're new to the show, my name is Jay. I'm an investor. I'm here looking for the smartest home for my cash. If that sounds like you, then I think you're going to like what we do here. My guest today is Luke Gromen, founder of Forest for the Trees. And we cover a lot of ground in today's conversation, but a key bucket that we talk about is the red lines. Red lines for Russia, red lines for China, and red lines for the United States. Lines that, if crossed, would trigger us moving into some kind of a new world order. So fascinating conversation. I know you're going to love this. As always, if you enjoy my style, I publish a weekly essay every Sunday on Substack. It's called the Jay Martin Letter, easy to find. I'll put a link right beneath this piece of content if you want to subscribe. Over 35,000 investors tell me they love it. You might love it too, so check that out. Now here is Luke Gromen. Enjoy. All right, here I am with Luke Gromen. Luke, it's great to have you back on the program. I appreciate you making the time today.
Thanks for having me back on, Jay. It's great to be here.
Well, let's start with a big picture question, and then I'm just going to pull on some threads. If you were to grade the overall economic health of the United States right now, how would you rank? How would you rank that?
I don't know. It's probably a C. Maybe it's a C minus. The challenge is that they've got a final exam coming up in the next week, proverbially, and the final exam is worth 90% of their grade for the semester. So if they screw that up, they'll fail. And if they succeed, then they'll pass.
What's the final exam?
Get the dollar down a lot.
Okay, so consequences of failing that mission to get the dollar down.
What we saw in August and September and into October on steroids. Dollar up, treasury yields up, even in a recession, risk assets down, wash, rinse, repeat until they get the dollar down.
And what's your confidence level that they can accomplish this?
Fairly high, actually. To my eyes, it seems like they began moving in this direction about a month ago, maybe a little less. And I think they have the proper motivation to do so. I think they're starting to see that they have a test, and that if they fail the test, what the circumstances are, or what the repercussions are if they fail it.
Can you play that scenario out a bit further from a time horizon standpoint for me? When you say we failed this exam, failed to get the dollar down, we revisit what we experienced in September/October, but on steroids. Walk that path forward for me a little bit, if you don't mind.
Yeah, it's ultimately it drives a forced debt deleveraging at the sovereign level. You're going to get, if you get the dollar up, as the economy, you get the dollar up. If they don't weaken the dollar, all else equal, you're going to, you continue to draw liquidity, Fed QT, et cetera. Okay. Dollar goes up. There's $14 trillion in offshore dollar denominated debt. Foreigners can't print dollars. However, foreigners do have a piggy bank of dollars. It's called their net international investment position. It holds $18 trillion net. 40 trillion-ish gross of dollar assets. 7.6 trillion of that are treasuries of that net, of that 18 trillion net. And as a practical matter, you sell what you can, not necessarily what you want to. So as the dollar goes up, U.S. deficits are what they are. If we don't weaken the dollar, deficits are likely to continue to rise. Growth is likely going to continue to slow. Dollar goes up. Squeezes offshore dollar denominated debt. Foreigners sell dollar assets, including treasuries. Obviously, we've seen over the last 3 months, the treasury markets aren't exactly liquid at the long end. In fact, they're very illiquid. China sold $20 to $30 billion in treasuries a month in August and September, per Brad Setzer. The 10-year treasury went up 80 basis points over those 2 months. And China has, $1 trillion in treasuries they can sell. So they could do that for another 20 to 30 trillion or 20 to 30 billion a month for 40 to 50 months. In theory, the U.S. can't afford 80 basis points in the 10-year for very long at all, every 2 months. We know that. We're seeing that. It feeds on itself. It gets very convex. So what you end up with is a net supply situation in the treasury market that is untenable. So you get U.S. treasury issuance deficits of $2 trillion plus foreign selling of, call it, $1 trillion plus Fed QT of $1 trillion plus, banks have been plugged with treasuries. They own 4.1 trillion. Pensions have been plugged with it. They own, let's say, 3.6 trillion. It gets to be a very one-sided trade if the dollar rises. And so you just go into this feedback loop of dollar up, rates up, dollar up, rates up, dollar up, rates up until they break it with a much weaker dollar. And the longer this goes, and that can be done a number of different ways. That can QE, that can be a whole lot of different things, but that's what that looks like.
So walk me through the playbook then to get the dollar down. And are you seeing this being put in action today? You seem super confident they're going to succeed in this mission, at least in the interim, correct? So what are you watching, Luke?
I'm fairly confident. I wouldn't go all the way to super confident. Okay. I'm encouraged. I'm cautiously optimistic, we'll say. Step one is you stabilize the treasury market, right? How have they stabilized the treasury market? 3 weeks ago, the Treasury Borrowing Advisory Committee released 3 reports. In it, contrary to expectations that they would not shift long end issuance into the front end, they did so. When you are having a supply demand mismatch in your borrowing markets as a sovereign, there's 2 game plans that you can do. You can do the developed market approach, which is slash spending, or you can do the emerging market approach, which is just push all your long end borrowing to the front end and, borrow on a payday loan, basically. And we, of course, did the latter. That helps stabilize the long end. That helps stabilize currency markets in the short run. We've seen Treasury General Account run down by Yellen over the last several weeks, which is a playbook she ran last September, October, when Treasury markets, Treasury volatility got similarly high as it was in September, October of last year, when the Treasury market was getting close to volatility levels that some experts suggest signify a loss of control over the bond market by the Fed. We got to those levels again recently in early October. And so we saw Yellen run down TGA. We saw a shift in issuance. We saw 8 or 9 different Fed governors in the span of 10 or 12 trading days all come out and say the bond market has done our work for us. We're done hiking, or intimate that at least, which helped put downward pressure on the dollar. And so we've seen the dollar go from 107 to, it's trading with a 102 handle today. That's encouraging. They need to do more. We had a 7-year auction today. It wasn't really good. The lower the dollar goes up to a point, the better it's going to be for Treasury market stability. It lowers dollar FX hedging costs for foreign buyers of Treasuries, makes the FX hedged yield more attractive to foreigners. So it'll strengthen the foreign bid. It improves global growth up to a point. All of that is good for Treasury demand. So I'm just watching. Wrote about it at the time as they were saying it, as hey, we wrote for clients in early October. We're now hitting volatility levels in the Treasury market where historically more liquidity comes on the dollar. And then we've kind of seen this primrose path, them follow it once again. Liquidity's clearly come in. The dollar's at 102, down from 107. So we'll see if they can continue it. Actually, pretty good outlook for pretty much everything but the dollar. It stabilizes Treasury markets. It's good for stocks. It's good for commodities. It's It's good for a lot of things. So let's see if they can continue to do it. It's good for tax receipts, which they desperately need. It's good for growth, et cetera.
So yeah, what do you make of this? I don't know, call it a rally in the S&P right now. I have a couple buddies actually that went to cash about 6 months ago, and they're now looking at a lot of their positions like Nvidia, DoorDash, whatever you name it. There's a handful of companies that are up 30%, in the last 45 days. What do you make of this rally, Luke? Sustainable, have legs, give you confidence, super fragile and vulnerable. What are your thoughts?
You tell me where the dollar is in 6 months, I'll tell you where stocks are.
All right.
If the dollar's at 90, 95 in 6 months, market's going way higher.
Yeah.
If the dollar's back at 107, this rally will end very quickly.
Okay. And let's say mission accomplished, dollars at 95, stocks therefore ripping. Do you think there is a return of favor to the speculative growth stocks, the same names that have carried the last decade? Or do you see a rotation to what I might call like more responsible capital allocation, commodities, looking for value, maybe yield? What are your thoughts?
I think it probably is more sort of the industrial / gold / commodity type stuff for two reasons. Number one, I think you're going to see some fundamental support for that with Biden's again talking about reshoring and convening a council to spend more money there, et cetera. I think from a technical / market macro standpoint, I don't see, if the dollar's at 95, growth fears and inflation weakness sequentially that has driven the long end down to, whatever the 10-year at the US is at 4.38 or something today, 4.4, whatever. Weaker dollar is going to stop weaker inflation and weaker growth in its tracks. And that doesn't necessarily mean disaster for these sort of, whatever we're calling them, the Magnificent Seven or whatever, but just sort of, the stuff that works really well with negative interest rates and slow growth, negative real interest rates and slow growth. Mm-hmm. I think you see, some stability at the long end. And then, in a few months, weaker dollar, you're going to see the long end rise again because you're going to see growth pick back up again. You're going to see inflation pick back up. And so I think that's an environment that is better for industrial gold stuff that, that tends to do well with inflation growth or reflation growth, and sort of real rates rather than sort of the stuff that has done really well. Some of these more bubble type things with negative reals and 0% interest rates, et cetera.
You think the geopolitical consequences and crises that are kind of blowing up all over the world right now, mainly Europe and the Middle East, impact that sentiment as well? Do you think that it creates a bit of a drive to safety or stability or cash flow? And how much do you factor in geopolitical events into your portfolio, Luke?
Over time, yes. I don't know, in the short run, who knows? I've been finding it very curious, right? As I'm getting, the geopoliticals telling me, or, not the geopoliticals per se, but it's the news, right? Telling me that what's going on in the Middle East, as tragic as it is going to spill into World War III. And then I'm watching oil every day going like if this was going to spill into World War III, oil would be at whatever it is, 78 or 74, whatever the heck it is. And to me, there's an element of all of this that is a little self-regulating, which is I think countries are jockeying for their interests at a time when each country has red lines that they have to accomplish as matters of national security. But there's an economic mutually assured destruction component to it. Oil at 120 or 110, if we get to the point where you get a hot war, that's going to be catastrophic for a lot of things, because that's going to push going to push all the U.S. allies into current account deficits, and they'll be dumping treasuries to buy oil, basically, to finance their current account deficits. Similarly, if the U.S. and China really, come to a head over Taiwan, I don't think people have fully thought through what that means. Like, markets will stop. There will be capital controls. Trade dries up. Bonds are dead. I mean, you would be able to own bonds, but you probably wouldn't be able to sell them either, because there would be some sort of capital controls installed, because the resulting inflation of trade breaking down would make what happened in 2020 and 2021 look like a children's tea party, in terms of the inflation. So do I factor it in? Yes, from the standpoint of over the long run, I think these changes that each nation are jockeying for in terms of their red lines, in terms of how they want the system to evolve, as a matter of each nation's enlightened self-interest, shall we say, or matters of national security for each nation. I think over time those will resolve, and sort of the Nash equilibrium on all those things is moving to a neutral reserve asset, like a gold, like a Bitcoin. And so for me, I tend to position a lot of what I own for the long term just unlevered, and just, just get there and wait for it to happen, and periodically check back in on it and say, hey, is this still valid? Is this still moving in this direction? Has something changed? And pay very close attention to events, because there are some very big things that could change. It could change that outlook dramatically. And if I'm wrong that there's some sort of energy productivity miracle, or something really changes geopolitically that slants it away from those types of things, then I'll have to adjust, and I'll be wrong and on some portion of that portfolio. But if it goes the other way into war, I think I'm also positioned in things that are going to do really well if I'm wrong and there's war. So it does factor in, but I'm more watching for what I think that could be major rule changes within the game we all seem to be playing.
Interesting. Some rule changes. And I'm curious, when you mentioned there's so many countries right now that have their red line, right, that they're either protecting or driving towards, just to protect their own security. Do any specifics stand out? And you mentioned the USA-China conflict and what that might mean in terms of capital controls and the bond market collapse, et cetera. Are there any red lines for China that stand out to you as most important that may, push over that line?
Yeah, I think if you listen to them and believe them, they say, Taiwan is a red line. Yeah. I think another big red line for them is the ability to buy energy in their own currency over time and commodities. They have to do that. If they don't, they will mathematically suffer a currency crisis and an economic collapse. It's an easy question of math. So that has to happen in their eyes. That's a red line for them, in my view. For Russia, I think Russia's red lines are pretty clear. They don't want missiles that can hit them in 15 seconds on their borders, which is understandable, in my opinion. John Kennedy certainly didn't like it in 1962 when missiles were in Cuba.
Yeah.
And we almost went to nuclear war over that. And I think Russia's other red line is we want to get paid in real money for our commodities, which is to say, we're going to settle in gold. We will accept local currencies, and we will net settle in gold. And we've been doing this, and we're going to continue to do this at the central bank level. Central bank gold reserves in Russia continued to rise after pausing. They've been rising since 2008. They paused during 2020 with negative oil prices, et cetera, et cetera. They've resumed rising in recent quarters. The U.S., our red lines, I think, are. I think we want to have essentially energy hegemony over Europe. We do not want Europe being able to buy energy in their own currency. That has been made clear to me over the last 20 years. Quite frankly, I've been surprised how far the U.S. has been willing to go, and how little, what's the right word here? How little the European policymakers have stood up for themselves and their people on that front. I think the U.S. needs. I think within that, there's then it breaks down. There's two red lines in the U.S. and they're mutually exclusive. There's a group that wants the dollar system as structured since 1971 to continue, and there's a group that wants to reshore U.S. industrial production because they realize the defense industrial base has become a threat to U.S. national security because too much of it is sitting in China over the last 20 years. And increasingly, the group that wants the defense industrial base and is willing to sacrifice the international trade value of the dollar and U.S. Treasury bond as the primary reserve asset, I think that group has gained momentum over the last 5 years. And I think the sort of, the Robert Rubin, Larry Summers wing of Washington that's, sort of protect the dollar as structured at all costs because it's really good for Wall Street, really good for Washington, not really good for the rest of America, increasingly. I think they've lost a lot of momentum. And so there's some sort of yin and yang there. So each country, there are some, there's some puts and takes. I didn't get into Japan, which is another big one, but those are, I think, some of the big, those are some of the big ones. And like I said, I think the Nash equilibrium is moving to a system where you trade energy in every currency, or at least the SDR5, and you settle on a net basis in goods and gold. And that's what the world looks like it's moving toward, amidst a lot of noise, a lot of volatility, et cetera. But that can change.
I'm Jay Martin. On November 30th, I'll be hosting an exclusive live online video event called Crisis and Chaos, The Changing World Order. I'll be joined by some of the world's top military experts, geopolitical analysts, and economic advisors. They'll be answering my questions and yours about the cascade of global crises since COVID-19. This event is for anyone trying to make sense of our crazy world. Find out what could be coming next and how you can prepare your mind, your money, and your family. Crisis and Chaos, The Changing World Order, an exclusive live online video event on November 30th. Click below to purchase your ticket now. What's the most common pushback you get from the concept of de-dollarization? And I want to ask because you brought up, one of China's red lines is being able to buy commodities in their own currency. One of Russia's red lines is being able to sell their commodities for real money. You can maybe say real money for China as well. They're happy to buy if it's in real money. I'm very curious about their gold stores. But what's one of the most common pushbacks you get against the trend of de-dollarization, Luke?
It's usually a misperception. I get the dollar's still used for 88% of global financial transactions.
Okay.
And it's like, yeah, and so what? The key number is not what you pay in, it's what you settle. And since 2014, global central banks have stopped sterilizing U.S. deficits. Foreign central banks' holdings of treasury bonds stopped growing in 2014. From 2002 to 2014, global central bank holdings of treasuries at the FX reserve level, as reported to the IMF, were equivalent to about 52% of the aggregate net increase in U.S. federal debt for those 12 years. And since then, it's less than 0%. They have not bought a single treasury bond on net since 2014. Now, what have they bought? Well, their gold holdings are up $400 billion in that time, with a lot of it done in the last 2-3 years. So to me, this, there's no de-dollarization. Look, the dollar's still 90% of transactions. The misperception is that, well, if they're paying in dollars, you haven't de-dollarized. Sort of. And I can see somewhat where they're coming from in terms of the pipes, but the pipes will change with digital currencies. The digital yuan, they're not going to need to use with CBDCs, not going to need to use the US dollar pipes. And I think that freaks out some people in the West, by the way, but that's a separate issue. What the pushback misses is that when China, who, oh, by the way, is a bigger trading partner with Saudi than the EU and US combined, when they transact, let's say they do it all in dollars. I don't think they're doing it all in dollars, but let's say they are doing it all, and they'll do it in dollars forevermore. Let's say that'll never change. What you're seeing happen is China gets dollars from the U.S. They run a surplus against the United States. They pay for oil from Saudi. Let's say it's all in dollars forevermore. The Saudis then are taking those dollars and they're buying Chinese goods to improve their own. When you see Saudi building new refineries in JVs with China, when you see Saudi buying golf tours, when you see Saudi buying Mbappe, and paying him $1 gazillion to play soccer, when you see ports, everything they're doing, water purification, all of these things are not financing the United States government, because in a lot of cases, China's making the components, because we don't make components anymore. We make dollars, bonds, and weapons. Mm-hmm. It's a vast oversimplification, but it's not that much of an oversimplification. Mm-hmm. So then who finances U.S. deficits as U.S. deficits are secularly rising because of demographics? Well, since 2014, it's one of two people. It's either the global private sector, in which case we get the dollar rising, and then we get rates rising, and we go into the sort of the problem we started off the show with, or the Fed or one of their proxies, SLR exemptions on the U.S. banking system, which is just Fed QE through the banks, for example, or the Fed does. And then we get the dollar down and everything else up. And so there's this misperception that, hey, the fact that 90% of financial transactions are still being done in dollars and that the dollar is rising and rates are rising in the US, that's proof that de-dollarization, it's actually not proof de-dollarization. It's actually proof de-dollarization is happening. It's because as the US runs these deficits, and these deficits are not sterilized at the central bank level. The central bank level is really the key in my view. It's not 90% of global transactions. What are central banks net settling in? They're not settling in dollars anymore. They're settling in gold. And you can see it in their balance sheet. Their holdings of treasury bonds have not risen in 9 years, going on 10 years. They have risen in gold. They are doing more deals in commodities around the world in local currency. That's irrefutable. It'll be slow and transitional. And oh, by the way, as it happens, paradoxically, it sends the dollar up, not down, which that part confuses a lot of people. And I understand why. It's a little counterintuitive. A lot of it ties back to what I talked about at the beginning, which is there's $13-14 trillion in offshore dollar denominated debt. If the oil market's a $2.5 trillion annual market, you take just a little bit of dollar flow away from the oil market, put it into yuan, you're going to pull just a little bit of supply away from the dollar market. And you're going to, against very big demand for servicing, right? $13-14 trillion in debt. And you're going to add just a little bit of supply of yuan into a market where there's really no incipient demand because there's no yuan loans outstanding, by and large. And so a little bit more supply of yuan when there's not a lot of demand, what happens to the price of yuan? It goes down against the dollar. If you take away a little bit of dollar supply where there's very big demand, what happens to the price of the dollar? It goes up. So there's a lot of misperceptions around, all of the flows and all of the impacts. The bottom line is that it's absolutely happening. Commodity markets are being de-dollarized. Global central banks are no longer sterilizing U.S. deficits and haven't been for nearly a decade. They're buying gold instead of treasuries. And I think the world's going to keep moving in that direction. And it's a little bit of a spur and break of like, okay, this process is happening very steadily, maybe even accelerating. But as it does, once the dollar gets high enough that it creates a problem, then the Fed and other authorities have to step in and inject dollar liquidity, get it back down, et cetera. So that's the biggest misperception. And, I suspect it's going to continue.
And is part of that when somebody throws a number at you like, US dollar still accounts for 88% of global trade, what's more important, the percent or the trajectory? And does that come into the conversation ever? It's 88% today, but what was it 15 years ago? Or 5, right?
What they pay in is irrelevant, right? Because it's just
you made that
right?
point.
I could pay you in a wooden nickel.
Yeah.
To me, it's about what we're storing our savings in.
Okay.
Right. When you think about an inflation, the great inflations are all about what? They're all about people not wanting to hold the currency. De-dollarization or central banks no longer wanting to hold dollars. They're holding gold instead of treasuries. Their gold reserves are rising. Their treasury reserves are not. And this, by virtue of the structure of the system, leads to paradoxical symptoms, which is the dollar goes up, rates go up, and until it breaks something, and then they come in with more dollar liquidity. The Fed, or increasingly, we get what we got earlier this year, which was Argentina goes, "Oops, we're out of dollar reserves. IMF, we owe you money. Help us." And historically, that was okay. Argentina goes into hyperinflation, and they're already having inflationary problems, but their currency goes to friggin' zero until, there is demand for it, whatever. What happened this time? China came in and said, no, allow us. Here, take our renminbi swap lines, take our yuan swap lines. And the IMF accepted them. And I don't think some people have appreciated the importance of that. You'll hear, Kyle Bass and others say, "Oh, the yuan's wampum." Okay, why'd the IMF take it? Did they convert them into dollars? Sure, possibly, I don't know. But again, don't go that far. The IMF took yuan in lieu of dollars. Keep saying it until you hear it. Like, how can you even deny that some level of de-dollarization is happening? And the point here is that once that dollar squeeze goes higher as a result of de-dollarization, China's over there waiting in the wings with yuan swap lines going, "Hey, we'll get you out of this. All we need is future supply of oil. We'll take this." When you see China sign a deal with Qatar, 27-year gas supplies, 27 years. The way the system used to work was China would hold treasuries to hold them over for their gas needs for the next 27 years. 27-year gas supply deals, just cutting out the middleman. They're not storing the supplies in dollars anymore. They're storing them in commodities, in gold.
Yeah. Okay. I have to ask you a question that might be sort of juvenile, Luke, but for China to execute this, as you said, all they need is future supply of energy, right? As an example, the 27-year deal with Qatar. Why is that the case? Why is what's most important for them to accomplish moving the yuan swap line model forward, future supply of energy? Talk to me about that relationship.
Because without energy, the whole thing breaks down, right? I mean, energy is the base layer to every economy. You can't grow without energy. Practically speaking, China's short energy. And, something that has been laid out by many, including Kyle Bass, that I agree with on this front is he laid this out in 2017 or 2019. Hey, China uses more and more and more oil. And oil is only priced in dollars, used to only be priced in dollars. And so if you have a case where China buys more and more oil and the price of oil goes up over time and it's only priced in dollars, sooner or later, their energy needs are going to reduce their dollar holdings down to zero. And as it gets close to that, they will have a currency crisis like Southeast Asia in the late 1990s. And then they will have to either shrink their economy to reduce oil usage or massively devalue their currency, leading to high rates of inflation to also reduce. So basically, the energy markets regulated global growth via the dollar, via the monopoly on the dollar. And so what yuan energy does is something that has never been an option in the post-World War II era, which is, every other country in that position. We're using more and more oil. Oil is only priced in dollars. We have a finite amount of dollars. As energy prices go up and our energy volumes go up, we're going to run out of dollars and we have a crisis. There was always one or two options: devalue the currency or slow the economy, stop using so much energy. Those were the choices. Now there's a third choice. We're just going to buy more than you want. And we will settle it on a net basis in Chinese goods and in gold that floats in yuan. So suddenly people say, well, why would anyone hold yuan? Well, because China is the factory of the world. So number one, presumably the Chinese will over time take more and more of their own currency for the stuff they make. Mm-hmm. And number two, the currency, when you bring gold into it, when it floats in yuan terms, is essentially the Chinese saying, listen, it's our currency and it's our problem. As opposed to the American system, which is it's our currency and it's your problem. If you call up a 200-day moving average of the price of gold in Chinese yuan terms, it's beautiful. It's like a friggin' 40-degree line up and to the right. So you do deals in yuan. Why would I take yuan? It's like the easiest sales job in history. I'm a foreign minister of some, setting aside the politics because they're messy. Strictly from an economic standpoint, I am the foreign minister of some oil producing country, the economic minister. And the Chinese come to me and say, I want to buy oil from you in yuan. And I say, okay, I take your yuan, then what do I do with it? And they sort of, on this hand, they pull out all of the stuff they make. And they're like, it's so good for Huawei 5G. It's good for all this stuff you're making anyway. We'll make that for you. Like, okay, well, what if I have anything left over? They go, well, here, let me show you this. This is the chart of gold in yuan terms. It's up and to the right. And so anything you can't find on our shopping list on this side in yuan, just put it in gold. And over a 5-year period, your yuan purchasing power is going to rise in gold terms, as opposed to treasury bonds, which have now actually collapsed over the last 20 years in real value. It's a very compelling case. Now, like I said, that sets aside the politics of it all, right? The Americans might be in the next room with a proverbial or literal gun at my head, and that certainly can change things. But from a purely economic standpoint, that's what's happening. It has been happening for over a decade. It's very easy to see if you watch it. And once you start seeing it, you can't unsee it. You see it over and over and over and over.
When you pull up the metaphor, the Americans might be in the next room with a gun to my head, preventing us from participating in what otherwise is a perfectly logical trade. Sure, I sell my commodities for yuan. I buy the stuff I need that's made in the factory of the world. If not, I park it in gold with that beautiful preservation of my purchasing power, et cetera. Is that related to, from your perspective, one of the Americans' red lines being maintaining energy hegemony in Europe? Is that the proverbial gun to Europe's head? And if they lose that hegemony, they lose that influence. Are those two things related?
Great question. I in short, yes. Ultimately, it's, what's been going on in Europe, I think, is the grand chessboard with Brzezinski that he wrote in 1997. It goes back to Mackinder in, I don't know, late 1800s, early 1900s. I should know the date. I don't. When he published his theory of the world island, right? Whoever controls the world island, Eurasia controls the world. And so I think there is a school of thought in Washington that and I think this school of thought's been around a long, long time, right? You go back to, I can't think of, I guess it was Ismay, Colonel Ismay, in England, right? The point of NATO is to keep the Americans in, the Russians out, and the Germans down. It's been sort of foreign policy forever to try to prevent Russian commodities from marrying up with German and French industry, because if it is, it competes with the United States extremely effectively. And I think we've been watching that 100-plus-year-old story play out over the last 5-10 years. These sort of gas pipeline wars. Is it the right thing to do for us? I'm not sure. It's the right thing to do for the dollar as it's been structured since 71. It's not the right thing to do if you want to reshore industry, because what we've been doing is cutting off Russian energy from Europe, redirecting it to China, making it very, very cheap for China. So now China has a competitive advantage vis-a-vis the world.
Yeah.
Locking it in via pipelines. Once it's locked in via pipeline, it barring a war, it ain't going to stop flowing. And then draining our natural gas surpluses that we could be using to compete very effectively industrially and rebuild our domestic industrial base. Converting it into LNG, which is expensive, and then shipping it to Europe, and making our coastal cities compete on global markets. So you're basically increasing U.S. energy costs domestically to keep the Russians out of Europe, pushing the Russians to China, it's higher inflation over time in the U.S. because otherwise our energy costs, particularly vis-a-vis gas, could be a lot lower. So is it all related? Yes, is the short answer. There is some element of it where it is around supporting the dollar. And to your point, everything that has transpired with that over the last however long has been very good for sort of the dollar wing of Washington, right? What's good for the dollar is good for Wall Street, it's good for Washington, D.C. It's not really good for the rest of America, well, at least on balance, but who cares is sort of their attitude. If you want to reshore industrial production in a major way, you need cheap energy feedstock. And the last thing you would want to do is run pipeline to Houston and turn it into LNG and ship it to the Europeans. You'd want to keep it here, rebuild factories, etc. So, we'll see. There's been a little bit of that as well. It hasn't been enough, but we'll see over the next few years if it builds some momentum.
It adds to your case about what China needs as a future supply of energy. You touched on Qatar, and obviously the relationship with Russia, the relationship with Russia, access to their energy. And I think I probably read in one of your newsletters, this winter they're accessing Russian natural gas at 50% the cost that Europeans are. Special deals like this make a massive difference. When you think about that picture and the trajectory of, just like deals like this that really strengthen China's position globally. And then one of their red lines is Taiwan. Can the U.S., so if Taiwan is a red line for China, is Taiwan a red line for the U.S.? Can they afford to have that be a red line right now? Or are they too vulnerable and too overstretched already? And that's maybe something they'd have to let go. What are your thoughts on that?
I think from a supply standpoint, it is a red line for the U.S. as well. It's a great point. When you look at, anyone who hasn't read Chris Miller's book, Chip Wars, really ought to. It's excellent. And it runs through the history of the chip industry all the way up to the modern day and sort of the primacy of Taiwan. And it gives you get done reading the book and you realize that, the whole Taiwan thing has like zero to do with freedom and any of these other, BS reasons they give us when this stuff, it's chips, full stop. We couldn't care less if they were, run by whatever. It's chips and it's access to chips. Is it a red line? So yeah, absolutely. It's a red line, particularly given sort of, American military technical primacy still, what is in the needs those chips. There was a white paper. It's incredible. There was a white paper out in 2021 from one of the Army war colleges or one of the think tanks looking at sort of we had to destroy the village to save it logic, literally running scenarios of, is there a scenario where it makes more sense to destroy Taiwan than let it fall into Chinese hands?
Wild.
Right? Yeah. So, and again, maybe in a vacuum, I don't know. But that tells you it's a red line.
Yeah.
And there's not a lot of thought given to, okay, the day that happens, you understand the bond market's done, right? Like who owns a bond when Taiwan's gone, right? Supply chains are literally going to stop. So it's a red line. Can we do anything about it? That's a question better left to somebody else. I've read yes and no, and who knows. Certainly the publicly available stuff that you get from consultants like Rand, et cetera, very clearly point out a progression over the last 15 to 20 years where it used to be like, yeah, we win going away to like, toss a coin, if there was a conflict 6,000-7,000 miles, whatever it is from U.S. borders in and around Taiwan. So it's a red line.
Yeah, that makes sense. And that book, because people are going to ask in the comments, Chris Miller, and it was called Chip Wars.
Chip Wars, yeah. Wars. It's a great book. It's a really important book. It's easy to read. It reads actually very much like a sort of like an adventure novel or a spy novel, if you will. It's pretty cool at the development of the chip industry, and from very much a layman's term, which I'm the total layman in the chip industry. Is really enjoyable, and it's very, very informative. I think very important.
What's your take? Do you have a take on I have to ask, because you mentioned Larry Summers earlier, and we were talking about a couple of the red lines the US has, and the second was sort of this battle between the 1971ers, call them, that dollar system, and those that are looking for moving the defense industrial base from China back to the US, and how those two things are opposed. I think you dropped Larry Summers' name as one of those who's more of an advocate for the 1971 style dollar system. Curious to me that President Biden met with President Xi in San Francisco. 2 days later, Altman gets the boot from OpenAI. Obviously, hilarious backlash in-house, probably a lot of conversations that I'll never be privy to, but he's reinstated along with Larry Summers now on the board. And if there's ever been a company that strikes me as exclamation mark in terms of importance to national security, like OpenAI might be it, right? What's your take on that scenario as you understand it?
I'm not close enough to have a strong opinion other than to say I agree with you that, to me, it smacks of some sort of national security dynamic, particularly around the Larry Summers news. I mean, he's pretty connected. So, the timing, the location, all of it, in terms of San Francisco, that they were all in their meeting, all of that did not escape my attention. I just don't have enough information or background to have a strong opinion on it one way or another.
Yeah, cool. Okay. Yeah. And I'm just speculating, but when I read through it, and actually Dr. Pippa Malmgren had some excellent op-eds covering that as it was unfolding, and maybe painting the case that Summers is kind of the US lane claim, right? Putting an adult in the room, as she described it, actually.
Yeah, it's adult, maybe. Yes, yeah. I'll leave that. It's putting an insider in the room for sure. Put it
yeah. Better words. Okay, awesome. I want to wrap it up with, what can you share on where you've allocated capital right now for, I know you're a long-term thinker, as am I. My audience is long-term value investors, Luke. So given, framing the portfolio and the conversation we just had, talk to me a little bit about how you've allocated capital as of today.
Yeah, I've been, for most of this year, haven't moved a whole lot around. I've been significantly overweight gold, significantly overweight Bitcoin, significantly overweight short-term US Treasuries, sort of 2 years in. I've been significantly overweight cash for most of the year, beginning in, call it early to mid-October. I began shifting some of that cash actually more into gold and Bitcoin on weakness. In those, they're both pretty heavy positions for me, because to me, it's just, I think about it as either they're going to weaken the dollar or they're not. And if they do, it's going to work. And if they don't, the crisis that ensues will be sharp and pronounced in all likelihood, and quickly force them to weaken the dollar, chasten them to weaken the dollar meaningfully, and probably more than they would have had they just done it in the first place. So I like those. I was negative on long-term bonds for most of the year. I'm sort of like, I didn't catch this rally here. I'm not one of those who thinks, the 10 years going back to 2 or 3. I think I think we're in a higher for longer regime. I think ultimately, so I don't know that I don't feel like there's real value in long-term sovereign debt here, particularly after this sort of bounce higher in the price, lower in the yields. I still like oil. I think oil and oil-related names, again, they've had a bad couple of months. With that said, it's been very interesting to me to see how badly the alternative energy space has done with positive real rates. And that's, I think, noteworthy. A lot of this stuff doesn't make sense at 4 or 5% rates. And if that's the case, that sooner or later is going to, I think, filter its way into long-term oil and sort of fossil fuel demand. Probably benefits nuclear as well. I'm not really there in terms of uranium. And I still have a pretty good position, mainly through private equity investments in electrical infrastructure in the United States, sort of boring, generation agnostic metal stuff. And I think ultimately the electrical grid in the U.S. is going to get revamped one way or another. It's already started to some degree, but I think there's a long runway, I think, on it over the next 10 to 20 years. And I'm looking to be long-term greedy, not really as a trade. So those are some of the things I'm thinking about. Basically, I don't think I finished the thought. As the alternatives get shown to not work at 4 or 5% rates, I think you'll see oil demand, sort of terminal oil demand, these peak oil demand numbers we get from the IEA and EIA periodically, those numbers are too low. Those numbers are going to have to get revised higher, demand numbers globally over, 6 months, 12 months, setting aside sort of any cycle, just secularly. So I still think oil does well over time as well.
Yeah. Okay. And so in the core there, highly liquid and highly agile, right? Gold, Bitcoin, short-term treasuries, cash. You're ready for anything. I like that. Okay. Awesome. Look, Luke, always great having you on the show, man. I love chatting with you. I want to point everybody to your site, Forest for the Trees. It's fftt.llc or
dash LLC, fftt-llc.com.
Okay. And the Tree Rings report, by the way, is a great place for anybody to start. This is a weekly report. I get it every Friday. I've said this before, Luke, it's without question the smartest investment anybody who cares about macro finance, the markets can make, because it's a comprehensive breakdown of like the 10 to 12 most significant headlines that you and your team have seen. And then you give your summary, right? What really matters here? What is the tree ring in this headline? And there's tons of levels. There's some levels above that if you want to go deeper with Luke, but it's the highest quality stuff out there. I highly recommend everybody check that out. So appreciate your time.
Appreciate that. No, thank you very much. I appreciate that. And it's always fun catching up. So I enjoyed it. Thanks for having me on again, Jay.
Of course, man. All right. Till next time. Crisis and Chaos, The Changing World Order, an exclusive live online video event on November 30th. Click below to purchase your ticket now.